Federal Open Market Committee decided today to establish a target range for the Fed funds rate of 0 to 1/4%. Repeating, the Open Market Committee decided today to establish a target range for the Fed funds rate of 0 to 1/4%. Since the committee's last meeting, the labor market conditions have deteriorated, says the FOMC. The available data indicate that consumer spending, business investment, and industrial production have declined. Financial markets remain quite strained and credit conditions tight. Overall, the outlook for economic activity has weakened further. Meanwhile, inflationary pressures have diminished appreciably. In light of the declines in the prices of energy and other commodities and the weaker prospects for economic activity, the committee expects inflation to moderate further in coming quarters. The Federal Reserve will employ all available tools to promote the resumption of sustainable economic growth and to preserve price stability. In particular, the committee anticipates that weak economic conditions are likely to warrant exceptionally low levels of the Fed funds rate for some time. The focus of the committee's policy going forward will be to support the functioning of financial markets and stimulate the economy through open market operations and other measures that sustain the size of the Federal Reserve's balance sheet at a high level. As previously announced, over the next few quarters, the Federal Reserve will purchase large quantities of agency debt and mortgage-backed securities to provide support to the mortgage and housing market. And it stands ready to expand its purchases of agency debt and mortgage-backed securities as conditions warrant. The committee is also evaluating the potential benefits of longer-term Treasury securities. Early next year, the Federal Reserve will also implement the Term Asset-Backed Securities Loan Facility to facilitate the extension of credit to households and small businesses. The Federal Reserve will continue to consider ways of using its balance sheet to further support credit markets and economic activity. The vote for these policy actions was unanimous. In a related action, the Board of Governors unanimously approved a 75 basis point decrease in the discount rate to 0.5%. The board also established interest rates on required and excess reserve balances of 1/4%.
All right.
The spread to
Let's
a quarter. They did the discount rate.
Highlight through this here, and obviously there are several things we need to go through. I believe, and Steve will correct me, I don't believe they've ever established a target, quote-unquote, range of 0 to 1/4%.
Right.
And then they did, it looks like, and we'll follow up on this too, when they talk about employing all available tools to promote the resumption of sustainable economic growth and preserve price stability. They talk about an exceptionally low level of federal funds rate for a very long time. And they did go through, as Bill was hoping, talk about how they will be, over the next few quarters, purchasing large quantities of agency debt, mortgage-backed
look at the euro.
securities, as well as talking about doing more things for consumers. And obviously longer-term Treasury securities, and you can see that when you look at the 30-year Treasury, extending gains very strongly there. Let's check in with you, Rick Santelli. Dollar sliding sharply on this. Can you just give us the reaction there in the Treasury market?
I'm so glad you came to me. I'll tell you what, I'm watching the volatility in the interest rates into the 60s in 2 years, 10-year at 240s. But put on a chart. Here's the trade. The euro versus the dollar is just screaming. Since this news came out, it's gone through a couple of handles, and it's almost up at 140. So this is a weak dollar trade in the first primary knee-jerk reaction.
Yeah.
All right, let me just go to Steve Leisman.
Yeah.
This is the sea change, sort of different statement that you had expected.
Yeah.
Did you have any sense or any context that you can give us to what the implications are of a target range for the federal funds rate as opposed to a target?
Let's be clear. Here's the deal. The Fed has not been hitting its target. What the Fed is doing here is trying to align its policy with the reality of what the market has been, okay? They have set, for example, a Fed funds rate at 1 percentage point, but they've really been in the, let's say, 0 to 50 basis points with the fluctuation. What they're saying is now we can't really hit the target rate because of a bunch of things. So instead of trying to change the market, we're going to adjust our policy. 3 keys here, Aaron. The first thing is the range, as you mentioned. The second thing is explicitly saying they're examining going out and buying treasuries.
The longer-term Treasury
Bernanke
securities.
said to a new level, saying now it's going to probably be explicit policy. The third thing is the statement, for my mind here anyway, of keeping rates low for some time. Yep. This is the pre-commitment that people had asked about whether or not the Fed would provide it. They have now provided it. So now, instead of saying we're going to adjust this, we're going to take it back quickly, they are saying explicitly this rates are going to be low for some time. 3 key changes to policy here, all in one statement. Yeah.
All right, so let's get some reaction here from you, Bill Gross. Obviously, they're saying they're going to continue to buy mortgage-backed securities, which is the trade that you have been behind. You were, though, cutting your holdings of treasuries. Now they're coming out and saying specifically for the first time that they are evaluating benefits of purchasing longer-term treasuries. Does this change the way you're going to manage money today, now?
Well, let me modify that a little bit. We don't know where the Fed's going with that longer-term treasuries, other than from a Bernanke speech in 2002, where he identified longer-term treasuries as 2-, 5-, and 6-year treasuries. I think if the market believes that he's talking about 30-year bonds, I think they're going in the wrong direction. The Fed is not going to buy long-term treasuries. They may buy the intermediate portion. That's what Ben Bernanke and company believe to be long-term treasuries.
So you are saying that 2-, 5-, and 6-year treasury, that's what you would define as longer term?
Well, that's what Ben Bernanke did back in 2002.
Steve,
and other
it's
Fed
interesting, Aaron.
Aaron,
it's interesting where the movement is in yields that I'm looking at.
Yep.
Much stronger movement in the 10, although the 5 is down by 9 basis points. I don't know how it's moved actually since the Fed announcement. But people are thinking along the way that Bill has suggested, that maybe the Fed goes out when it says longer-term treasury, they mean 10s and 30s. It's yet to be defined. There's no actual information in this statement other than the unclear phrase of longer-term treasuries. And no new information on when the MBS is going to happen, although they did say it will be next year, as they've announced.
Yeah, they did say early next year the Fed will implement the term asset-backed securities loan facility. Okay, so that's not new. Ken Volpert, what is your reaction here?
I love it. I mean, it's basically the Treasury is going to lower intermediate-term yields and make it very unattractive to own Treasuries, and that's going to be very good for the spread sectors. I would think there's going to be money moving out of Treasuries over the next 6 months and into corporate spreads, and I think we'll see tighter spreads in that market. Right now, corporate bonds in 1 to 5 years is about 7.5 percentage points. 5 to 10 years, 8.25 to 8.5 percentage points. This is a single A-rated investment-grade corporate bonds. So with yields going down in treasuries and agencies and mortgages, these other alternatives are going to look very attractive for investors.
Alan Blinder,
Bill Gross, can I ask you a question?
Yes, keep them short, Rick.
Okay, real short. Bill Gross, if the Fed starts buying agencies and mortgage backs, what does that do to a conventional portfolio's duration? Doesn't it come back on the backside and cause people to buy long-term treasuries to adjust that negative convexity?
Well, I don't think so, as long as they assume that these policies will be successful. I mean, what the Fed really wants to do is to reflate, and if they reflate successfully, if the dollar goes down like you just described, then we're looking at higher rates of inflation, and who wants a 30-year treasury at 2.9%?
No, I understand, but there is that spiral of buying that emanates from mortgages into treasuries. That's all I'm trying to acknowledge.
Hey, Aaron, can I just point on what the mortgage, what the traders think down here? Just a couple of quick comments. This hit all the points they were concerned with. Was the Fed going to help out the mortgage market and continue to do? Yes. Are they going to continue to fight deflation with all available tools? What else are they going to do? How long are interest rates going to be low? For a long time. This hit all the points that stock traders wanted to hear.
Right, it exactly did. And Alan Blinder, though, what we are highlighting from this statement is that, A, it did a lot of things that it has never done before. You've got this range. It's talking about specifically what the Fed is going to do outside of interest rates, specifics on quantitative easing, and talking about how low they'll keep the Fed funds rate, or that they're going to do that for a very long time.
Yep.
What did it take to get a statement like this?
I think it took a lot of persuading, because you know that the whole FOMC was not aboard this train at the beginning, and they haven't been in previous weeks. I think it's very significant that it was unanimous. What this says to me is that Ben Bernanke has very good control over the FOMC, and amazingly, they decided to do everything, that it wasn't a question of a menu. As you know, people talked about moving out the yield curve. People talked about this pre-commitment to keep the Fed funds low. By the way, both of those are aimed at the same objective, getting the longer rates down. The quantitative easing, without using the phrase, was in there. Buying unusual assets was in there. He, or they, I should say, basically decided to shoot every bullet in the cannon today.